special subscriber webinar for the month. If you all can hear us, please press in a yes through the chat window. If you all can hear us clearly, please put in a yes or no through the chat window. Okay, just give me a minute. Hope the voice is clearer now.
Better than before.
Okay, great. So we shall move ahead with webinar. In case you have any difficulties during the course of the webinar, please do let us know and we will be happy to help you. So without much ado, let's take our first question for the webinar today. The first question is from Mr. Before we start with the questions, let me introduce my colleague Chaitanya Kekre, who will be answering your questions for today. So the first question for the day is from Mr. Sushil Chandra Kapoor. What is the future outlook in 2013?
Sir, I would like to inform you that we would be conducting a special webinar that will deal specifically with future outlook for 2013 in the, somewhere around 10th of January. This will be much more detailed, specifically dealing with your question. So I would answer that question much more detailed way in that webinar. But just to give you a brief, what we think currently as of now is that uh, we, as far as India is concerned, we believe that the reform measures that the government has taken as of now are quite half-baked attempts towards reforms. Further, we do not foresee much of any headway happening towards controlling the fiscal deficit of the government. And being a election year, that is general election is expected in 2014 or late 2013. So be that we believe this being the last budget of UPA 2, this is going to be a bit populist budget. So things might not look very good as far as India is concerned. On US, while yes, there are certain near-term concerns regarding fiscal cliff, but we believe that this is something that will eventually, at the last hour, will get cleared. Uh, things, part of it may be rolled over till March 2013 or even later, but the broad contours would be generally be agreed in between the administration of Obama and the Senate that has been dominated by Republicans. The concern continues to remain at the Europe. We believe US will not be much of a concern in 2013 as of now. That is what we are foreseeing. We do not see any betterment in the situation in US, but we also do not see anything going bad in US also. But the concerns will continue to remain in Europe. Uh, we see things can become worse in Europe. Uh, some of the countries may eventually have to leave European Union, or a massive bailout may be needed for these countries. So this is what we see on the broad horizons. Uh, at a micro level, we believe that 2013 to 14 may be a good time to start investing into certain rate sensitive sectors, provided if the budget is a bit good on the fiscal deficit. If that does not happen, well, some initiation can be made, but not something wherein, say, I would start putting about 30 to 40% of my portfolio into this kind of sector, but some initiation can be made. Otherwise, I believe that domestic oriented stories with low debt companies and companies with quite a large economic sense in most of the sectors will continue to do well. We believe 2013 to 2014, both the years will be much more be stock specific cases rather than a sector doing well. Sector doing well of all kinds have already been played out. 2011-12 was the year of FMCG, pharma. 2012 was the year for cement, and these 2 years have not been good for that good for say metals and other commodities. We believe same thing may play out again in 2013 and 14. Sectors might not do well. But to certain extent, if RBI takes some decisions, then banking may be an exception to this. But overall sector look outlook might not be a good way to go about it. Stock outlook would be a good way to go about it. Same way, this is what we'll take in two webinars that we'll be conducting in the month of January. One on future outlook for 2013, and again we'll be conducting a webinar for our subscribers, which will be dealing with stocks to look out for in 2013, stocks that we can buy, stocks that we like to avoid, as well as stocks that we would like to track in 2013. I hope this answers. I understand this is not a complete answer to your question, but the reason I am not answering completely is because we will be taking special webinars specifically dealing with your question.
Thank you, Chaitanya. The next question is from Mr. Umakant Bhatt. Do you think banking sector, bank Nifty, will grow better than Nifty? Is there any relation like this in the economy?
See, if you look at banks specifically, banks play a very important role in economy compared to all other industries. So whenever a economy is expected to do well, typically you will see that banks will do relatively much better than the overall economy, because banks are much more levered towards how the economy behaves. If let's say GDP growth were to increase, things were to stabilize in Indian economy, you will see that what would happen is credit outlook will be better. People will be taking more loans for houses, for their cars. Corporates will be going after much more expansion projects. These are all things wherein loan book of bank expands, business of bank expands, profit of bank expands as a result, and these are good things for banks. The bad things for banks typically happen during recessionary times, when also during times when RBI may be trying to increasing interest rates, because these are the times when some of the loans that have already been given can become bad. The way we saw in the last year, Kingfisher uh, Airlines loans had become bad. The way we saw last year that certain loans made to state electricity board could not and we continue to be funded further. So banks will do well whenever economy is expected to do well. So for banks, we believe yes, if RBI were to do certain rate cuts, things may look well for banks. Though specifically for banks, dealing with banks, what you need to keep in an eye for next 1 to 2 years is a new rules called as Basel 3 would be getting implemented over next 1 to 2 year, and during which certain banks may have to raise more capital to satisfy those rules. So while the business may do well, the rise in stock price might not be commensurate with the betterment in the business, because some dilution may happen with these specific banks. It is a case again with certain specific banks, need not be with all the banks. So you need to again look at a bank specific level, but on a generalistic level, if the economy does well, banks should do well. So on an average to good economic performance, banks should do well than the overall economy as such.
The next question is from Mr. Harshad Pandya. From beginning I joined with you, I was that only three stocks show for buy in Nifty 50. When can I buy other stocks?
Sir, what I would like to point out to you is that we believe in certain philosophy. One of them, the primary is that uh, you can make superlative returns if you go through a value investing mode, wherein you concentrate your portfolio into certain good stocks bought at a decent price, and they would give you big outsized return over long term. So yes, using our website, you might not see that every month, every week, every 6 months, and I may come up with a big buy reports for you every time. Now, having said that, whenever we see that certain stocks are available to us, these are stocks, let us say, companies with very sound fundamental business models, but because of certain reasons, one of events like the case of Maruti in the last year, or wherein market may be inherently too uh, under too risk averse towards this particular companies, like certain like it is happening as of now with respect to metals. So in these cases we do come out with an buy recommendations of the sort that you see on our website. Now because of the nature of our philosophy, you will not see too many stocks coming at it. Uh, though we do understand that at times there may be such opportunities lurking that we are not capturing completely using our current method. We are actively looking into seeing how many more such opportunities I can capture for you. But please be still be sure that I would make it very clear to you that because of the basis of our philosophy of investment is value investment, uh, you will hardly see that we will come out with a recommendations wherein we say yes, just invest and you will get make 5%, 7% in a week, or 8 to 10% in a month. These kind of recommendations might not come from our end. For as far as I can tell you, this won't come from our end. So ours would always be in a place where you will find very good qualitative stocks recommended. We would sometimes make error, unfortunately, that is the part of the game, but we'll continuously work hard to restrict this as far as possible, and try and see that we come out regularly with a good number of stocks. But these would not be the numbers quite high. Or if you are looking into just top 50, it is unlikely I would ever come with an top 25 companies or top 25 or 30 companies coming into buy list. Most probably I would be the site that would look very boring to you, because month on month I'll be recommending just those 4 to 5 companies, because we continue to believe that these would be available to at quite a deep discount. To give you an example, we have been shouting to say such for over last 1 year that Sterlite is a good buy, and some of our investors have acted on it, and they have bought when we gave buy recommendation at 95 and at 100, and they are sitting at 100 as of today at 117 to 119, whatever the close may be of today. The point that I'm trying to make again is our MRP still stands for that at around 200, and we believe this will be something that will be closed or reached somewhere around next 2 to 3 years. If it happens, well and good within a year, but if it not, well and good. But giving you 100% return in 3 years, such kind of stocks, some you may come across only in few limited numbers over the year. You will not get quite a large number of such stocks.
The next question is from Mr. Shiraz Devani. How do you exactly do short selling? Explain the steps if one expects the stock to go down.
Uh, See, if you expect a certain stock to go down, I'll first explain what is the theoretical basis of doing a short sell, and then we'll go how it is done in exchanges. So if you look at short selling on a theoretical level, what short selling effectively means is, let's say you have a friend from whom you can borrow that stock, and you can then borrow that stock and give him sell that stock at open market, and say that stock was when you sold it at was trading at 100, and that stock was, let's say, Tata Steel. You sold 10 Tata Steel stocks at price of 100, and you got $1,000 out of it. Now you can keep that $1,000 with you, but remember you owe about 10 stocks to your friend of Tata Steel. About a month after, if the stocks fall down to, let's say, 98, uh, let's say to 90, uh, you need to buy that stocks again at the market price. So you'll buy back those 10 stocks at 10 at 90 rupees. So you'll be giving him about 9,000. So you'll be giving him about 900 rupees back 900 rupees stock to him from the market, and you will be giving him back those 10 stocks that you had borrowed. Now he's in effect, because he is having a different expectations, he is at no profit no loss. He had 10 Tata Steel to start with. He ended with 10 Tata Steel after this transaction, and you have made about $100 from 1,000 you have started, and you got 1,000 at the start, and then you had to just give back 900, so you got 100 rupees as your profit. Now the mechanics how it works is, when your friend is lending it to you, he's also not going to lend it to you for free. He's going to charge you certain amount. Now this is what you also have to factor in. It is not just important whether the stock will fall down, but also how much will it fall down. So if your friend was lending it to you for let's say 10% per month, then this is not some uh, short selling would not work for you, because while yes, the stock will fall by 10 percentage in a month, but you also have to give that 10% money that you have borrowed, that is on 1,000, that is 100 again to your friend. So this is on the theoretical base. How it works in the exchange level, as of now, as far as I know, short selling is not yet allowed for retail participants. It is allowed only to the institutional players. So the institutions can short sell, retail cannot. The only way retail investors can go and do this is, the only way the retail investors can go and do this is by shorting futures. Hello, uh, Eric, can you hear me? uh, Hello, sir, can you hear me? Yes. uh, yeah, they can hear me. uh, was I clear about short selling till now? Can you just let me know through the chat window? Yes, Mahesh from Mumbai, he is saying that in case of futures, it would be more of trading rather than investing. I understand, sir, that it would be more of case of trading rather than investing. This is partly to do with uh, the fact that you are still restricted to just 3 months oriented timeline. But unfortunately, that is how long the current regulatory environment allows us to short sell at retail level. At retail level, you cannot have long-term short sales on the story. If you look at even at options, you are as retail investors, we are allowed only 1 month, 2 month, or 3 month options. Long-term options are not allowed to retail investor. It is just negotiated at institutional levels. Uh, uh, Mahesh, you are saying you cannot hear me. Can you hear me? Hello, can you hear me? Uh, the next question. Thanks, Tanmay. Thanks, Naveen, for letting me know. So the next question is,
Okay, so the next question is from Mr. Prashant Kadam. What are the prospects of Sun Pharma and Lupin?
okay, let's look at Sun Pharma as a company. Now, if we see at Sun Pharma as a company, we believe that the performance of the company has been really very good, uh, and we continue to believe, based on its the R&D and the expected uh, product pipeline, that the long-term prospects are also very good. But if we look at the valuation side, Sun Pharma is not available to us around DP, but it is still available to us at somewhat below MRP at 738. So you may think of investing some amount of it, but I would request you to still and think that a chunk of your amount can be better invested at somewhere around your discount price rather than investing as of now. If you are to invest it for now at current market price, you may get decently sized returns. Let's see, if you were to invest somewhere at MRP, you should expect somewhere around 11.15% returns. At 738, you should expect not more than 13 to 14% return coming to you over the next 1 year. So for outsized return, I would request you to wait to invest in DP rather than investing in current market price. I would also like to point our investor thing called as company pulse. Whenever you have time, especially for companies that are specifically in pharma, because pharma, there is lot of divergence in between each and every different type of pharma companies. Uh, there are certain companies that have quite a good patent profile, quite a good product pipeline, but there are others who do just contracted out works to you. So valuation and outlook for each of these companies would be different. A good way to understand about companies is going through our company pulse report, wherein you can see the revenue segregation according to each and every divisions for the company. You can see how the in detail what the 10-year X-ray analyst that the analyst understands, on the basis of which he is giving a very green, very good and outlook for the company. You can also understand that when we say that the long term prospects are good or bad, or not so good, then what are the reasons under which we are saying. So based on this, you can have much more better understanding of our basis of valuing a company. So see, sometimes what happens is that my expectation of valuation of a company can be very different from some other analyst expectation of valuation of a company. I'm not saying that analyst is wrong or I am wrong. What I'm saying is, because of our different expectations, different timeline and different time horizons across which we are seeing the same company, we may have different expectations. So some broker, especially analyst reports that come through brokerage, those are more oriented towards short term returns to be given to the investors. So they will be looking at more quarter on quarter performance for the company. We are more interested in long term and giving long term returns to our subscribers. We tend to look at more on year to year basis of returns. We are more interested in seeing some stories that, and with over a period of 3 to 4 years, will give a very huge returns to our investors. So it is always good to go through company pulse and looking into the long-term prospects of the company. If nothing, we have segregated this report into three broad segments. One is the introductory part, in which you can get the revenue segregation, what the company does. It's generally not more than 100 to 150 words. The next is, even if you go through this diagram, wherein in very concise form we have highlighted what are the 4 to 5 major reasons because of which we are saying the 10-year X-ray is good. Second, even again on the long term prospect, you can see what are the reasons because of which we say what are the positives for this company and what are the negatives for this particular company. So if you do this way of analysis for study it whenever you have time, or at least when you have bought the company after following our advice, it is always good to go through the company pulse report.
Okay, so the next question is from Mr. Ashish. He says, thanks for the webinar. Do you have any view on Geodesic? I have purchased Geodesic at rupees 37. Should I hold or book loss?
Now, geodesic is a very specific case. Reason for geodesic's case been very specific, and this is in spite of if you see our valuation of wherein DP is 49 and MRP is 123, the CMP is 23. The reason I am taking this case is, see, I have been consistently telling our customers three aspects. First, you need to select the stock that is right. The 10-year X-ray has to be good, and the long-term prospect has to at least has to be somewhat good, or good, as in both the 10-year X-ray should be green or orange. Again, long-term prospect should be green and orange. And on that basis, after that, once it is done, then you should go after the right price, and then you should go for the right timing. Now, if you look at geodesic, we do not see its performance has been very good. Even the long-term prospect, while we have given it as somewhat good, it is somewhere dicey for specifically for geodesic. It is somewhere in between good. अगर हो गया तो and it can do somewhat good, but if not, then it cannot do. One of the big reasons for this geodesic is that somewhere around 2007 to 2008 they had done external commercial borrowing of from foreign markets, through which they have borrowed certain chunk of money from the market. Uh, Now, the implicit reason that the management had given at that time was they were borrowing so that they can acquire some good, decent companies in European markets, so that they can expand their brand portfolio. Now it has been already been 4 to 5 years after the geodesic has done that, but we see that the management has not done with whatever the money it has borrowed. Now this kind of behavior at times can be an indicator of bad management practices in both ways. Either the management is doing some shady work, or management is clueless of what to do with this kind of money. Now think of it this way: you have borrowed some thousand crores of rupees, and you are paying some interest cost on it, and you are not doing anything. You have neither invested it in any other company, you have not even invested in building your own capabilities. Then you're just paying away interest money which would have been better given to your shareholders. And this has not been done by geodesic management. So yes, probably it may happen that company price may go increase beyond this, but on a prudent side, I would rather book my losses, get out of it, and put my money into some better companies and try and avoid companies like geodesic in future.
Okay, so the next question is from Mr. Vijay Bijlani. Certain shares are trading at the MRP. Still, your time signal is to sell is not given. What are the reasons? And there are a few more other questions. We'll take those later. So let's get the answer to this one first.
Uh, Sir, yes, it would happen that there will be some cases wherein, uh, let's take Asian Paints. It is one of the case where I think what you're pointing out to would have been pausing. Yes, it is one of the case. If you look at the MRP is 434, that is 4,344, while then at the current market price is 4,390. Now for this particular company, the timing signal for sale has not been generated. This can be for two specific reasons. The timing signal that looks for a certain type of parameter, type of pattern, sorry, uh, because of which the algorithm tries to see whether this is somewhere close to the peak that may come for this particular stock. Now, if the pattern does not occur, then the timing signal for sale would not get generated. It is more pattern based rather than a judgment taken by the analyst. We are trying to see if a certain and a better algorithm can work out on it to give you a much more better output. But we had over last few weeks done a certain analysis of how good the timing signals have been. Now on the buy side, the timing signals have, what we see on the preliminary level is that the performance of buy signals have been very good. On sell side, yes, we see that the performance of our pattern recognition method had not worked quite well. So it is not working as well as we had anticipated. So we are again tweaking our logic and seeing if a better logic can be developed on the sell side. So I'm accepting that yes, this was a place where I didn't work as a better solution as we saw thought about it before, but we are working on developing a much more better solution of it. You'll see it happening over next 1 to 2 months, wherein we'll be coming out with a better sell plan as well as a much more better buy plan also, in spite of a much more very good and returns on the buy plan. On the buy signals, just to let you know, the worst performance of our buy signal was an about 15% return that the stock had given, and the best performance was wherein the stock had given 70% return. So that was the range within which all our buy signals had been. On the sell side, things have not worked really well for our on the basis of what performance. Uh, we are working on giving you a much more better sales signal. But on a conservative side, if you are very conservative investor, then if you see that till we come out with a much more better plan, which should happen within the next 2 months, during this month period, if a stock is trading substantially higher than our MRP, you may start thinking of selling it. Best way would have been always to drop a query through our customer care, and let the concerned analyst take a call whether he thinks that this is a good time to sell, or if you wait for, let's say, next 1 to 2 weeks or about a month, you may get a much more better price than what our MRP is saying, so that you get the most optimum price over and above our MRP. This is what I would suggest you to do for next 2 months. But be assured that we are cognizant of the fact that our sell pattern had not worked as well as our buy pattern. So we are working on tweaking it. You will see another changes happening over next 2 months.
Let's take the next question by Vijay. Uh,
So
so
his
his
question, second question follow up to that is also related to the cell signal. Uh, yes, the cases for where cell signal has not performed well is both wherein my pattern also may have failed, and there are also some cases wherein the valuation was at a very conservative level. If you see, just if I take the case of Asian Paints, valuation for Asian Paints was at a very conservative level for about 6 months back. Only now it has moved to a place wherein we think now this is much more better valuing the company than as it was before. There are certain aspects of Asian Paints that was not being captured by the model that we were using. Same way, we are developing much more wider range of models that can address this kind of companies. Typically, you may see this kind of performance with companies that have very, very strong brands. Companies that have very, very strong brands. Remember, these are the brands which are not generally present in the financial statements. Like, there is no term within the financial statement that says that the brand of Asian Paints has this kind of value. So our model does not inherently tends to capture that. We are working on different set of models that will tend to capture that. We believe that this will also address the part with these type of companies wherein the valuation of that particular company is on a at a very conservative level. On a similar line, but there is also certain type of another cases like JP Associates, which I will take in much more detail in later part of the presentation. Just to give you a highlight. Now, if you see here again, our current market price, the current market price is much more higher than the MRP and what the DP is. And while the sell signal has been generated, we believe that our MRP in these kind of cases are very clear. I'll give you my reasons for this in the later part. But there are three kinds of cases. Cases where I am very conservative in which are these are cases like companies like Asian Paints, Pidilite. Then there are cases wherein my sales signal pattern has not worked. We are working on these both these cases. Then there are third cases wherein we believe we have taken a judgment call that in spite though the current market price been at a very high level, we believe these are the companies we would inherently are telling our investors to stay away from. These are the companies wherein either the business model, management capability, or inherent the economics of this business is something that we do not believe are something that will make money for our investors. So we are inherently asking them to stay away from this kind of companies. So for two companies, two types of things we are working on. Third component type of thing, we are taken a judgment call that we are not going to recommend this kind of companies, even if market may be valuing them at a much more higher level than what we feel they should be valued at. No, no, next question.
we have one more question from Vijay. How the fiscal cliff issue in the US will affect the Indian markets?
Uh, I believe as an analyst that fiscal cliff is something that has been made too big than what it really is. Fiscal cliff will not impact even American markets to the extent that most of the American media or the even in the media people have been raising it. What needs to be understood is, yes, a real cost, that is a tax rates for American companies and American investors will certainly increase. But what also needs to be understood is that the fiscal deficit of US is running at around 6.86 to about 7% level. These are historical high levels of fiscal deficit that the US is seeing. Just take this into consideration. During the Bush administration, the fiscal deficit in dollar terms was about 200 to 400 billion dollars. In Obama administration, we have already crossed about $1 trillion of fiscal deficit. That means each year $1 trillion of debt gets added to American GDP. This is not considering other certain social programs, expenses of social programs of American government. If you were to consider that, the debt level of US government will be much more higher. So fiscal cliff, I believe, is certainly made too big a issue than how much merit it really deserves. After having said that, somewhat of negativity would definitely happen, because certainly cash flows of companies will decrease to a certain extent. That cash flows will flow out to US government. Uh, but it will not be to an extent that it has been made out as. It is not something that we would see because of that 10% or 15% correction happening in the market. uh, Specifically for India, uh, I do not believe fiscal cliff is a big event as far as Indian markets are concerned. uh, Things would have been different if Indian government would have taken a much more proactive attitude towards inviting investments, because then India would relatively look as a much more better investment destination than for American companies than investing locally in US. That would have happened, but because of the policy logjam in our own area, because of reforms, half-baked reforms that we have been pursuing, and no reforms that we have had over last 1 year, this would turn out to be non-event, because it is not going to happen that American money would start getting diverted towards Indian economy in any way. Fiscal cliff would not be a reason. Ben Bernanke printing more money could be a reason, but fiscal cliff would not be a reason for this. Next question, next one.
Okay, the next question is from Mr. Pavan Velari. Which stocks are better to buy through SIP method, monthly SIP? And he also has another question, which is, I bought Petronet LNG a year back. It's almost same price even after a year. What is the future of Petronet LNG?
Yeah, sir, there are certain type of stocks that you can really look into buying, like an SIP. These are the type of stocks, if you were to, let's say, use our even if you were to use our Money Works for Me filter, let's say, look into all companies that are very good, and let's not look into how they are priced as of today. Uh, I just want like to make my point clear. Then I will enter. Now these are the stocks that you can think of making investment like an SIP. Systematically, you can invest. Typically, stocks. Let's look at Bail. You can make investment like an SIP. This is a stock that will not give you a return within next 1 year, 2 years. It will happen to give you returns only once government takes certain decisions uh, regarding how power sector reforms needs to be pursued. So BHL is some kind of stock that will give you returns over a bit longer term than 1 year. It probably 3 to 4 years it will give you a return, but 1 year it might not give you a return. So BHL is a stock wherein if you invest money systematically over on a month on month basis, it's much more better way of allocating money than allocating the whole chunk right at the start of this. So this way you get one of the good prices of BHEL. You have spread it out here and cash flow. The cash flow that you have not yet put into BHL can be put into other companies. It can grow over there, and then slowly it can also start entering into BHL. So company like BHL, NMDC, Crompton Greaves, these are the MOL, these are the type of companies that you can think of investing like an SIP. Green companies who have 10-year extra that are green, who have long-term prospect that are green, that are available at least near DP or not very close to MRP, at least in 50% in between DP and MRP. These are the companies with wherein the fundamentals are very good. Companies have performed in a very good over last multiple years. These are the companies wherein you can look like an SIP. Excuse me. Looking at Petronet LNG, your second question. If we look at Petronet LNG, yes, the stock, if you look as not move, if you look at year on year basis, but if you would have followed our advice, the stock was available at near DP price that we had recommended of 126 about 6 to 7 months back, and right now it is about 159. That translates to about 20 to 25 percentage returns to you over this 6 to 7 months period. So companies, other companies that do not have good 10-year that do not have very good 10-year XA but have, let's say, very good long-term prospects, it is always better to follow advisory based on our model of buying it on near DP in the buy zone, or once the signal is generated, or at least at DP, while making a major part of your investment, so that you get at least a decent side returns.
Okay, the next question is by Mr. Mahesh Vartak. Which are the best Nifty stocks to invest in for a 5-year horizon?
Um, Again, Mr. Mahesh sir, as I clarified right in the beginning, we are conducting a special webinar in the month of January. The exact dates will be mailed to you, wherein we will be discussing about 13 to 15 stocks, which wherein we'll recommend you stocks that you can invest in 2013, that can give you very good returns over long term, over 5 years or 2 to 3 year period. We'll also be discussing certain type of stocks that we would be specifically asking you to stay away from, and also asking discussing certain stocks wherein if these are available at some good prices, we will be very interested. These are something that we believe that such an opportunity can and arrive in 2013. I will not like to disclose those names because I am bounded by our policies, but we will be very very pleased with what report you and what webinar that will be conducting. It will, some of the companies would be really be uh, big calls by us, wherein we will be taking a big call, wherein we'll be recommending to buy certain big names, and we'll be then asking you specifically to sell certain big names compared to what you may be hearing in the market. We'll be explaining our reasoning for each of these stocks. So I just request you to be patient. We'll be coming out with a specific webinar detailed for this particular aspects. But on a functional level, if other than this way, if you are ever looking for companies that you need to invest for 5 years, and I'm assuming you are a type of person who would not like to invest too much of his time looking into the details of the company, the bare minimum that I would like you to do is look for companies through our Moneyworks for Me filter or decision maker that have had good value creation basis over last 10 years, then they have very good long term prospects, and see to it that these are available at near DP price or at buy signal. Just do this bare minimum. I think things should work out well. The only thing that you need to follow after that is that the analyst, because of certain unforeseen event, uh, has not changed his expectation. Just then come back monthly or quarterly and just check whether the analyst has not changed that expectations of the stock. I think that would work very well as a principal basis. But specifically, just wait for a few more days. We should be out with our mailer to you when we'll be conducting such a webinar.
Okay, so we have the next question from Mr. Sunil Shah. MRP and DP confusion of Bata India Limited. As of now, DP is 375 rupees, MRP is 549, current market price is 896, which is much higher than MRP. Total group script is above MRP since 1 year, not evaluated.
Yeah. Now, Bata India is a very, very interesting story. The script has Bata India stock has done extremely well over last few years. One of the big reasons has been Bata India always had a very strong brand, but what it lacked was in a good business performance. We have seen that this is a turnaround story, and yes, this has rewarded investors quite well. Having said that, the reason we continue to keep our MRP at this level compared to what market is pricing is that currently market is having too much of risk averseness towards certain other sectors that are not dependent on domestic demand, that are either commodity based businesses, or that are businesses that depend too much on the performance of a global economy like Infosys, TCS. Market has tried to stay away from that, and because of that money has moved towards companies like Bata, HUL, Marico, ITC. These are the companies that are trading at very rich valuations. On a valuation basis, this is a call that we have taken on valuation basis. This is not a judgment on the company or the company's management. We are saying on the valuation basis the company is very richly priced. A person can buy into the stock, but I don't foresee that he making a decent size returns on this. He would be lucky enough even to get a fixed income FD like returns by buying into Bata India as of now. That does not mean Bata India is not a good company. It's a good company, good management. Things have done very well, but market is pricing at it very steep valuations. We do not see that these are the valuations at which we will recommend our investor to invest into Bata India. Uh, what you need to understand is just because the market is pricing these companies at a much more higher price, this will not bias us towards giving a much more higher price to a company. We need to see that the valuations are really good, they are really decent enough for investor to invest, so that they make real long term money.
Okay, so we have the next question by Mr. Narayana Reddy. Money works for me filter. For the stocks filter based on discount range, how do we know if it is the right time to invest? For example, only stock Opto Circuits is listed for 50% MRP filter. Can we invest in this stock now?
First, sir, what I would like to tell you is the money works for me filter does not filters on the basis of the DP price that we have given. It is just saying that below MRP this is available at this much discount. That does not mean that our DP price is also at the same level. Having said that, what you can do is that you need to go through a multiple type of cases. For example, if you were to look at all companies very good and say let's say 0 to 25% discount to MRP, you may actually find some very big brands in it: Coal India, TCS, Wipro, Grasim Industries, and all this. Now the reason these are having a much more lower discount price is not because of the fact that uh, uh, we are abandoning our principle of margin of safety, but the margin of safety also has to look into the fact that how risky the business of the company is. If the company's business is much more risky, I would like much more higher margin of safety. If the company's business is less risky, a lower margin of safety will suffice. So this is the reasoning. So just don't concentrate on looking at companies that are below 50% below MRP. Also look at other ranges also, because at times certain companies might not get highlighted to you just because their business model is very good. Their business model has very strong competitive advantages. They are large players in their industries, and because of that we do not foresee very high volatility in the business performance of the company. Stock performance there may be, and if that happens when there's not much high volatility in business performance but high volatility in the stock performance, then during the times when stock prices are low, we'll start aggressively recommending these stocks to our investors to invest into. Now taking specifically for a case like Opto Circuits, I would like to make one sort of announcement to our friends over here. Specifically for a company like Opto Circuits, please stay away from this company. While yes, this comes out as a green company below discount, something like, and just using our this current principle, you every what I have been telling you till now, you will say, okay, this is the company to be looked at. Well, because we say that the 10-year X-ray is good, long-term prospect is very good, and then again, the current market price is very cheap, steep discount to our DP and MRP. The reason I am asking you to stay away from OptoSecret is, if I look into just on the basis of financial statements, yes, this is what the company would be looking. But these days we have started to suspect the financial statements of Opto Circuits as such. We do not and we believe that there is something wrong in the way the financial statements have been made. We do not see cash flows of Opto Circuits happening, and because of that, and there are large increasing concerns regarding Opto Circuit. We would like you to stay away from this type of company. Now, what is the announcement I would like to make? That the 10-year X-ray that we have been looking till now has been just been looking into certain few aspects. Uh, when I will be discussing JP Associate, I will give you a glimpse into and of some of those aspects. It looks into the sales growth, the EPS growth, book value per share growth of the company. Now, these are, if you look at all these things for especially for Opto, things look very good. Sales have been growing, if nothing, at an average of 35 to 40% each year. This is phenomenal growth rate, one would say. Same thing is for EPS. But when you look at into cash flows have not been growing at the rate at which and the earnings have been growing, and this is a bit of a concern to us, and because of that reason we are a bit suspicious of the numbers of Opto Circuits. Now, what announcement we are trying to make, I am trying to tell you, is that we would be starting January looking into actively looking into such type of financial shenanigans, what we say shady methods that company use to portray a better picture than the what the company really is in. We'll be looking actively into such type of companies, and this will also get incorporated into our 10-year XA. So at times you will see that these are all looking green, but we would starting January be rating these companies as red companies to be avoided. The reason being, yes, financial statement says it looks all hunky dorky, but if we do not trust those financial statements, or there is something wrong, some way something is not fitting right in the jigsaw puzzle, and because of that we are saying that the company is not doing well. This will start happening again in January. This is one of the biggest learning that we have had in 2012, that we need to look much more deeper level into what are the qualities of financial statement that the companies are putting out. Is the quality of reporting really good? If the quality of reporting is not good, we are going to state firmly and clearly that these are the companies to be avoided, even though the financial statements are saying that this is a very good company. We are going to say, because we don't trust these financial statements, these are the companies to be avoided. I hope this answers your question. I will just like to repeat again, please stay away from Opto Circuits as for now.
Okay, so the next question is from Mr. Anthony Alfred. His one question was about our Opto Circuits. I think you answered that specifically. The next question is, you have recommended Maharashtra Seamless.
Yeah.
The stock has been going on for some time now. What is the criteria you used for selection? And we would like to know the scenario so we can avoid it in the future.
Yeah.
We have a similar question by two other customers. One is by Basav Raj. He wants to also know about Maharashtra Seamless. And we have Sri Ram Reddy also asking us whether we should buy, sell, or hold Maharashtra Seamless.
Yeah.
So we'll answer this one now.
Uh, uh, Looking into Maharashtra Seamless, this is not like Opto circuits, fortunately. Condition with Maharashtra Seamless are two pronged. There are certain near time uh, risks oriented with Maharashtra Seamless, because of which it is trading at substantial discount to a DP price. I would like to clarify over here. I am equity research analyst who looks into metals and mining companies. So this Maharashtra Seamless is the company that I analyze. So if you throw any brick bats, that has to be directed towards me. Now, if we look into 10-year X-ray of a Maharashtra Seamless, this is a company that does not has any debt. There is not much of a debt to speak for. Second, the ROIC historically of the company has been decently very good. It has averaged at around 20 percentage in recent times. When the order flow from 2010 to 2012 has not been good, it has been somewhere around 13 percentage, and the lowest been around 11 percentage. But if you look at debt to net profit, it has not been that high. We believe that because of that, there is not much of business risk to the company. Now, what is the business of Maharashtra Seamless? Maharashtra Seamless typically makes pipes. Now, these are the pipes that are used in where the demand for these pipes are much higher when the industrial activity is much higher. Uh, Now, for companies like Maharashtra Seamless, it is not just the industrial activity of India. Even if the industrial activity or industrial demand is much higher in any part of the globe, things can do very well for Maharashtra Seamless. Now, the reason why Maharashtra Seamless has not been doing well as far as stock has been concerned is because there has been a slowdown in how the future order book has built up for Maharashtra Seamless. This is largely due to the fact that because of concerns regarding US natural gases. See, over last few years, one of the biggest buyers of pipes were oil and gas companies in US and to certain extent Gulf. This was because of the shale gas revolution that was happening in US. Uh, because of that, large piping requirement was there for both at the drilling wells as well as then transporting those gas from the exploration area to the marketplace. Now, because of the large discoveries that have been made in US as of today has become self-sufficient as far as energy requirements for US is needed. Some policy experts also believe that today there is a very big possibility that US can become a net exporter of energy rather than importer of energy. To take it just a divergent view, to take a divergent view, some power plants who used to use coal-based boilers, they have now moved to a boiling creation generating steam using the natural gas because the natural gas prices have been very low because of sudden spurt in demand for sudden spurt in supply of natural gas. Now, US has a specific law that restricts export of natural gas and oil. We believe that one of the biggest policy decisions that Obama administration will take over 2013 would be a repeal of this law that bans export of shale gas and of natural gas and oil. This would result in slight. This will result in an increase in natural gas prices in US. To give you an example, Reliance KG-D6 basing gas that is made that Reliance and that Reliance markets is sold somewhere around dollar 4.2 MMSCMD. Similar level quality of gas in US is sold have been selling over last year around just $2. This is very low price. It is such a low price that many of the people who are in the business of exploration and trading of gas will not be even be making much money. Because of these reasons, there has been slowdown in the piping related activity for this business. But having said that, the company sits on a decently sized cash of 300 crores. If we look at the pricing market cap of the company, it is about 1900 crore company, but it has an already has a cash flow of sorry, it already has cash of 300 crores plus uh, it does not has any debt. So once the things gets a bit stabilized on this, you should see that it may look well. On a very pessimistic note, I would not suggest you to add any more further position into this company. Good price point to add into this company would be about somewhere in between 200 to 250. Now I am not to saying that the stocks may fall down below this, but that will be a good position. Another good thing to look at is a price to book value, meaning if the company were to sold completely to an investor, then its book value is much more higher than what its stock price is. These kind of companies, why it might say take some time for the company to stock to perform. These are the type of companies that value investor typically buy into. Uh, you may take it may take some time, but this will the company which will give you good size of returns again. Just on the conservative side, you may try and buy into this company a bit more if the prices are because of certain market uh, conditions. If you can get this company again at you can get this company somewhere in between 200 to 225 or 250 levels, then this is the at that time I will request you to buy into this company. But as of now, we are not foreseeing any problem with the company at the business level. There have been some slowdown in the order flow, but it is not such that it warrants a much revaluation of the MRP or DP at a much more steeper level. Some slowdown in the quarterly numbers have come, but it has not been that bad as previously we were expecting. I hope this answers your query. Uh, be clear that we are cognizant of the issue with Maharashtra Seamless and we are tracking it closely. We believe that for now market has been irrational in and pricing it at a much more lower than its book value, given the fact that the company has no debt. But I think this may work out well. I request you to stay invested into this company. Uh, let me see. Hi. Can you just let me know if the volume is now high? Can
Okay, we have a follow-up question by Mr. Basavraj on Maharashtra Seamless, but the volume is very less in Maharashtra Seamless. So,
uh, uh, Basavraj ji, this is going to be unfortunately a problem with Maharashtra Seamless. The reason is promoters have, if you look into Maharashtra Seamless as a company, it is just a 1900 crores company. So these kind of companies will tend to have very high volumes. Secondly, if you see about 55 percentage of that is held by promoters. There is no pledging also by promoters. 55 percentage is held by the promoter itself. Now in these kind of companies, 55 being held by promoters, institution holding another 26%, so nearly 72 percentage, sorry, or nearly about 77 to 80 percentage of the stock is nearly out of the bounds for the market. On you have only about 20 percentage of stocks that is trading. 20 percentage typically translates to just 280 crores of stock that is typically traded by retail investors. Now, because of the nature of both it being a low market cap, second, very large holding by promoter as well as institutions, it this is unfortunately going to be a problem that the volumes are going to be less. One good aspect to look into is that the promoters have been steadily been increasing their holding into this company. uh, Second is institutions also have a very strong holding into this company. They're quite a good thumbs up for the company. These need not be always be a case, but if this is there, then this is a good thumbs up to the company. Plus, volumes are unfortunately because of the market cap and because of the low float, low number of retail ownership of this stock is always going to happen that the volume would not be very high for this company compared to in a certain large cap or other of its peers. I hope this answers your question. Just let me know through the chat window if this satisfies your question.
okay, the next question is from Mr. Parag Storwala. He's asking how about starting PMS for large cap, mid cap, and small cap, and reviewing it on a quarterly basis.
Mr. Parag, I would like to again let you know we are actively considering starting PMS. We have already started groundwork on starting a PMS offering also, wherein we will be offering solutions that would be mix of customized requirement for specific to the client, because it will be co-creation way, wherein we will actively participate with you in developing a portfolio that meets your requirement. But on the also on the other way, we would like to adhere to what are our basic principles, that we would like to be unbiased. We would not like to see to it that our customer we would like to see to it that our customer makes an decent good returns for our customer. But on the same side, we would not like to see to it that he needs to churn his portfolio a lot, because the only person who makes money in churning of the portfolio is the broker and nobody else. So we would like to be a much more advisory suggesting role, rather than taking your money and investing on your behalf, because that would introduce us to a conflict of interest from which we would like to stay away from. We would like to believe that a collaborative, a customized solution that looks into what your specific aspects, what are your future plans for your own life, and then designing a portfolio would work out much more better for our subscribers as well as for us, if it works well for our subscribers. So we are actively working on it, but it is take a bit long. It is you understand, it's a very complex product that we are working on, because what we are trying to do is we are trying to develop tools that are used by mutual funds across the world, while designing portfolio for themselves, and then we are trying to use make it as simple as possible to be used easily by retail investor, yet it not losing its capability, its ability to give out a very robust kind of solution. So it's a huge jump that we are trying to make. This will happen over a period of next 6 to 7 months, but this is a bit stretched timeline, but we are working actively on it, and you will be seeing those changes happening in the year of 2013. To our folks who are our subscribers, 2013 is going to be a very exciting year. We are going to make lots of big changes in the way we value our companies, in the way we look into our companies, in the lots of new changes that we will be making in our products. So these are the things that we will be making into our companies.
Okay, we have a question from Mr. Sushil Chandra Kapoor. Please comment on Reliance Industries. Is it worth investing?
Is Reliance Industries worth investing? Reliance is a very complex business that it has become now by putting its fingers into lots of unrelated businesses. A very good investor, a partner of Warren Buffett, Charlie Munger, he says that people should not move too much out of their core competence. Core competence of Reliance was always in oil and gas and refining business, but for some reason Mukesh Ambani and his team believe that Reliance has core competence in moving into retail. Reliance has a core competence in moving into telecom. Let's see how it plays out, but as of now, I am a bit skeptical. Let's look into retail business if, as such, even if Reliance were to do, let's say, outsize, let's say 2 lakh crores of turnover on retail business, typical margins in this kind of business is just 3% to 4 percentage. Now if with such a low margins, even a 2 crores to 2 lakh crores to 1 lakh crore business will just add about 3,000 to 8,000 crores in a year. For a company that is today earning a much more higher amount of profit from its other businesses, it this is a too much of an time spent that Reliance is spending, too much of management time is going to get spent on this particular company, uh, on this particular venture without too much of returns. Let's look at its net sales. Reliance net sales today is about 3.5 lakhs, and if I see it's even if I look into key, let me just check. With a net profit margin of about 5 percentage. Now a 3.5 lakh crore business with a net profit margin of 5.23 percentage, and please remember this is it's one of the worst performance. It is still 15,000 crores of an return. Now, even if the company were to do 2 lakh crores of additional business to retail, it will just add about 4,000 to 8,000 crores. This is not something that we would like it to focus on. We would be more interested in it focusing on increasing in its performance in its core business, that is oil and gas, that is refining, that is petrochemical. These are the three businesses wherein I would like to see its net profit margin move back from 5 percentage to somewhere at least around a 10 to 8 percentage level. Having said that, uh, there are certain regulatory issues with Reliance, specifically on its oil and gas sector. Till that is settled, we do not foresee Reliance becoming something of a buy kind of recommendation by us. Uh, we believe that this regulatory overhang with respect to how the pricing of the natural gas that comes from KG-D6 basin would change from 4.2 to next, because anyway the prices are expected to get reviewed in 2014. So based on that, call can be taken on Reliance, but as of now I would like to stay away from Reliance because there is nothing. We believe that based on whatever the things are happening in Reliance, the company is very fairly priced. It somewhere around 850 or 860, it would be somewhere where even I may dare to say that it is also so, inching towards becoming a bit of uh, overvalued also. So this is where I would ask customers to stay away from Reliance for now. If things change in Reliance, probably we may look at Reliance, but as of now, let's stay away from Reliance. कोई और बाकी रह गया क्या?
Okay, due to time constraint, we'll be taking just one more last question. So since we are all here for profits, let's end it on a profit question by Mr. Dhananjay Nandi. In which level profit should be taken after purchasing a stock?
In which level profit should be taken after purchasing the stock? Sir, once you have purchased a stock, the right level at which you should take your profit out is a level that I would say depends on whether the fair value has been reached or not. Let's say, let's take an example and let us go ahead with that. Let us say, let's take an example. Let's take an Grasim. Now, for this particular company, when we are recommended it, the stock was trading somewhere around 2200 rupees, and you could have bought it at a very very low price than the discount price. uh, this is some at that time Grasim was also somewhat similar to like what Maharashtra Seamless is today, that our DP was way higher than the current market price of that company at that time. This was somewhere around January of 2012. The company's current market price would be of somewhere around 2200 to 2300 rupees. Now this company then moved up to 3700, and then it has retraced back to 3100. So it had moved up to 3500, then it has retraced back to 3000. Now a question can be made, should I have waited till 3700? Now what nature of decision that you need to make continuously is how much is the difference between the current market price and the MRP. Now if let's say the difference was in between 3500 to 3700, translates to about 200 rupees, which in real terms means just about 7%. Now do you have an opportunity somewhere else wherein you can make much more better returns than 7%? If yes, if you have identified that opportunity, then it is a time to take money out of Grasim, put that money into somewhere else where that opportunity lies. But if you have not identified that opportunity, then yes, it would be still be a thing that you stay invested. Yes, you might have made losses, but since you did not have an opportunity anywhere else to put the money, why not stay invested in a company that you had bought at a very good price? You have the company's business performance has been very good, and its business long term prospect was also very good, is also very good. So you can continue to stay invested. The decision that you need to make continuously is what is the fair value. If the fair value is, let's say, that is our MRP is 3700, and now the stock is trading at 3000, what is the difference in percentage terms? If the difference is something beyond something that is not to your liking, because you have certain good opportunities at some with some other company, then it is a thing time wherein you may think of removing your money from that company and putting your money to other company. Now the thing other decision while what you need to take on this is uh, the other company in which you are investing, how long the period will be wherein your expectation for that company will also get realized. To give you an example of, let's say, uh, let's look into another company. Let's say I would like to move from my stock from say Grasim to Sale Industries. I want to move from Grasim to Steel Authority of India Limited. Now, if I look at Steel Authority of India Limited, if I had moved around 3000 out of 3500 at that time, it was available to me at below DP price somewhere around so it's sorry, it was available to me near to DP price. It was available around 81 rupees or so. If could I would have bought into sale, but if I was of expect thought process that because this will take about 2 to 3 years for it to move from 80 to 108 or much more higher level. Then sale, I would not remove my money from Grasim. I'll stay continue to invest it into Grasim, because my realization with Grasim might probably happen in a year or so, while my realization with sale would not happen that fast. So the choice that you need to make is time and how many percentage difference is between the current market price and the MRP. If the current market price is already overshooted your MRP, the only thing that you need to track after that is what we believe is whether the earnings growth are happening as per analyst expectation or better than that. So if the analyst expectations, when you go into, let's say, view details, uh, if the analyst expectation for, let's say, for sale was 15%, and if the earnings were growing at the rate of 15%, then you can stay invested into the company. This is what we are calling our sell plan. This is what we'll start implementing within next 1 to 2 months, and that will get actively implemented. This is what we believe will do much more better than the pattern based and recognition method that we were using to invest, to tell our clients to sell a particular company. I hope this answers your cell. I know I have not been very clear with this, but once I implement the cell plan on my website, I'll come back to you and I will explain you in a much more concise way of how to go ahead with the selling decision that you need to take, because then I would have created certain tools that would help you in taking this decision at a much more better way. I would like to take one more question. This was related to JP Associates. The reason I would like to take the question of JP Associate is because I would also like to share how, on a broader level, how do we look into companies at a first glance basis. Let me go into the Excel sheet. Sorry. Yeah. Now, if you look into this Excel sheet, I would be very brief in this because this is a bit complex thing, but I will try and explain what we are dealing now. Now, the highlighted area that you would see, this is what we call is basically calculates what is the bare minimum return that the company needs such that the company will be at least be even. What do we mean by this? Think of it this like this. You are a businessman. You borrowed certain amount of money from the market at rate, at let's say 10 percentage rate. You borrowed it at 10 percentage. Now, just to break even, you need to have an 10% profit, such that you can pay off this 10 percentage. Let's say you borrowed 1000 crores from the market at 10% rate. Now you need to generate at least 100 crores to be in a place wherein you need not give out more money from your pocket. If you generated just 80 crores, then you need to give 20 crores to the market participants from your own pocket. Then these type of companies are companies that you call as value destructing companies. These are the type of companies wherein we do not believe that there is a case for investing into these kind of companies. Now, if I were to look into some different type of company, like let's say HUL or Castrol, or even sometimes commodity companies like Ambuja Cement, which is in similar business like Jaiprakash Associate to certain extent, as far as cement business is concerned. Uh, Now, these are the companies that would borrow at 10 percentage, but they would be generating again profits like 150 crores or 400, 200 crores, 300 crores, and while the amount that effective amount that they have borrowed would be just 10 percentage, and these are the companies that we call as value creating companies. Now, this cost that we call as weighted average cost of capital or cost of equity, this is compared with whatever their return on invested capital is or return on equities, and on that basis we say whether these are value creating companies or not. Now, if you look at Jaiprakash Associate, you will see all red over here, and you will see again red over here over the equity value creation. Now, because of this being red, we believe that Jaiprakash Associate over last since 2005, we believe has not been a value creating company, and because of that we are not sold out on the story of Jaiprakash Associates, even though it has seen a decent size revenue growth, it has seen a decent size and a profit growth, but we do not see that commensurate with the how much capital it has on its book, it is really creating any value for its shareholders. That's why when Jaiprakash came out with the statement that it was looking for a buyer for its cement business, we were not surprised, because we were clear that the rate at which it was building cement plants was not sustainable given the nature of the cement business and a cycle as it is. Once we are clear with value creation, this has been our fundamental principle. If the value creation is negative, we generally would rate these companies henceforth as red companies. Second thing that we would like to look at, how is the growth been panned out for companies. Now, if you look into case of HUL, while the value creation for HUL was happening for quite a long time, the growth was not happening till 2009. It was only from 2009 when the MD of HUL had changed. HUL started to actively look for pursuing policies that would lead to growth without going for diluting value creation. Now, and it is not surprising that once you see it this way, that the stock price of an HUL has moved much more higher from its 2009 level after that. So this is the second metric that we will see after value creation, how the growth is happening. Once these both are happening at a good numbers, then we say that it is a green company or orange company or red company. This is the basics under which we at our end take a first look at the company. Then when we see certain specific years that are highlighted or certain specific areas that get highlighted in our this tool, we would and do a much more deeper level of analysis. I hope this helps you understand how we at our end do the analysis of 10-year XA. When we take a judgment call whether the company is a good company or a bad company, we follow two basic principles. One, the company should have the capacity to develop value consistently. Second, it should have the capacity to grow at a decent size rate. If these two are there, we are going to say that these are good companies. I hope this clears our valuation method. We'll be coming out with blogs that would explain this in much more detailed way. But I hope this explains to you to certain level the process that we follow while looking into a company at first glance level. Uh,
So that brings us to the end of this webinar. Hope we've answered all your queries successfully. So wishing all the customers a very happy new year and hoping to see you all in our next webinar. Till then, happy investing. Mostly this time I took we took only the ones who had come.
मैंने रिकॉर्ड नहीं किया क्या?
अल्लाह बोल मत यार.
शायद.
Oh shit. Oh shit. Crap.
But I had started.
You started it now.
बीच में बंद हुआ क्या? हाँ अब भी बंद हुआ.
अभी हुआ है ना. हाँ. एक्सपोर्ट करना उसको.
यस मैं कहाँ पे वापस जाना पड़ेगा लेकिन.
कहाँ पे वापस जाना पड़ेगा?
अभी मैं ये एक्सेल शीट सिलेक्ट करते वक्त गया.
अच्छा ठीक है तो जितना एंड का थोड़ा बहुत गया है तो चलेगा.